Let me ask you something. When you think about growing your money, what's the first thing that comes to your mind? SIPs, FTs, maybe a little bit of equity? Here's the interesting part. There is an entire 53 lakh crore rupees outstanding corporate bond market in India that sits quietly in the background, generating steady, predictable income for investors who know where to look. It's not new, it's not flashy, but it's becoming more important than ever. Today, we are diving into the world of corporate bonds and why India is finally waking up to them. Look at what's happened in just the last couple of years. Companies are issuing record amounts of debt through bond and relying less on bank loans. Retail investors are finally participating. Earlier, it was only an institutional game, and registered bond platforms are making access ridiculously simple. Meanwhile, markets are volatile, geopolitics is unpredictable, rate cycles are shifting. Investors, beginners, and seasoned alike want stability without giving up returns. That's exactly the space corporate bonds now occupy, the calm amongst the storm. Think of a corporate bond as a deal between you and a company. The company says, lend me money today, I'll pay you interest regularly, and I'll return your principal on a specific date. That's it. Simple at the surface, but with layers that even experienced investors find interesting. Different maturities, different credit ratings, different yields, different levels of safety. It's a market where both cautious and strategic investors can find their fit. Three big things changed the game. One, borrowing costs fell. After the RBI's recent rate cuts, companies found bonds cheaper than bank loans and accessing wider investor pools. Two, banks became selective. Corporates needed flexible funding post the RBI risk weight circular change. Three, investor demand exploded. Mutual funds, insurers, FPIs, and now regular retail investors are stepping in. The result? A market that was once dominated by big institutions is slowly opening its doors to everyone. There are two worlds here: the primary market, where bonds are born, the secondary market, where they are traded. Surrounding this are issuers, retail and institutional investors, brokers and dealers, credit rating agencies, regulators like SEBI and RBI, electronic platforms that make the whole thing work. If stocks feel like a noisy marketplace, bonds feel more like a structured, well managed office. Less chaos, more order. Here's where beginners get curious and seasoned investors start nodding. Interest rates. When rates fall, bond values rise. Inflation. High inflation demands higher yields. Company fundamentals, cash flows, leverage, rating changes, bond structure, maturity, coupon type, special clauses, liquidity, how easily it trades, market sentiment, especially in uncertain times. It's a mix of macro and micro factors, simple enough to understand, complex enough to keep pros engaged. Three reasons why investors are paying attention: stability. Bonds don't swing wildly like equities. Income. Interest payments are predictable, great for anyone planning regular cash flows. Diversification. When equity zigzags, bonds cushion the blow. For beginners, this feels safe. For experienced investors, this feels strategic. No investment is perfect, and bonds are no exception. Credit risk. Lower rated companies can default, which is why ratings matter. interest rate risk. Longer bonds fall harder when rates rise. Liquidity. Some bonds don't trade as easily as stocks. These risks aren't deal breakers, they're just realities you manage with awareness, ratings, and platform choice. This part excites seasoned investors, but it benefits beginners too. Over the last few years, regulators have done a lot. Reduced minimum investment to rupees 10,000 face value, launched online bond platforms, introduced electronic bidding, pushed transparency via RFQ systems, created a backstop facility for market stability, allowed banks greater flexibility in holding bonds. Translation: the market is safer, more transparent, and more accessible than ever. Here's an easy self check. If you're starting out, they are stability, good for balancing your equity exposure. If you're building your portfolio, they're great for medium term goals and steady income. If you're experienced, you can play across ratings, maturities, and yield spreads to enhance returns. Corporate bonds aren't exciting, they don't go viral, but they quietly do the job and do it well. The Indian corporate bond market is evolving fast. More access, more transparency, more regulation, more participation, and more relevance in a world looking for stability. As investors, understanding this market, even at a basic level, can transform how we build wealth. And that's why we are here to help you decode, understand, and use these tools with confidence. Until the next episode, invest steady, stay curious, and go beyond yield. Investment in debt securities, municipal debt securities, securitized debt instruments are subject to risks, including delay and or default in payment. Read all the offer related documents carefully.